Lately, it feels like everything is on edge. Markets swing sharply from one headline to the next, economic data sends mixed signals, and the word recession gets thrown around in a way that makes people constantly want to brace for impact. When that happens, it's easy to blur everything together. Every market pullback starts to feel like an economic collapse, a slowdown is sold like a crisis, and that kind of confusion can be expensive. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist, and I own Diamond Point Financial. With Pointe Perspective, our goal is simple. Each week, we break down what's happening in the markets from the perspective of a financial professional, what you should understand about the economy, and how those realities can shape your financial planning so you can move forward with clarity instead of reaction. In today's discussion, we're going to do three things. First, we'll clarify the difference between the stock market and the economy and what recent market movements can actually tell you about what's coming next. Second, we'll break down the difference between a contraction and a recession and why most people automatically think financial crisis even when the data doesn't support that conclusion. And third, we'll bring it all back to strategy, how to monitor and adjust your financial plan with discipline. Because when these topics feel distant, it's easy to view markets and the economy as something happening outside of yourself, when in reality, your decisions exist at its core. Please do not be confused. The stock market is not the economy. People instinctively equate moves in indexes with real-time economic reality, but that's not an accurate link. The market prices expectations about the future, so earnings, interest rates, and policy long before confirmation shows up in economic data. That's why you'll see markets rally even when the news seems cautious, and you'll see markets pull back before official contraction indicators become clear. Last week and this week offer a real-world example of that dynamic. Recent market movements aren't waiting for the economy to confirm anything. U.S. futures dipped recently after tariff policy shifts and renewed global uncertainty, even while broader indexes still posted weekly gains. At that same time, sectors like AI-related stocks and semiconductors are back in focus heading into major earnings reports, and that anticipation alone is shaping positioning. Markets don't wait for payroll data, inflation releases, or GDP revisions. Those are backward-looking numbers. They price what investors expect those reports to imply before they even happen. Now, right now, one of the most common questions I hear is, are we headed for a correction or a crash? It's also one of the top trends in investor searches. The reality is that markets naturally go through corrections, and after several years of outsized gains in U.S. equities, the statistical likelihood of periodic pullbacks increases. We've also discussed that this is expected to be a volatile year. Midterm election cycles tend to bring policy uncertainty, and political and economic tensions are already elevated. That combination alone can increase short-term swings. But corrections are not recessions. We see them far more often than people might realize. They are simply the market repricing, usually a reaction to sentiment shifts, valuation adjustments, or geopolitical headlines. What we may be seeing right now is a leadership transition. Recent data shows rotations affecting broader indexes. Longer duration growth stocks have experienced intermittent sell-offs and rebounds, and broader market performance has been mixed depending on sector exposure and global developments. These shifts tell us where capital is moving and where investors believe returns may strengthen or weaken. Keep in mind, volatility in the market often precedes economic confirmation. Behavioral signals like clustering volatility, sector rotation, and widening credit spreads can be early indicators of shifts in risk perception. When those signals appear before economic data turns negative, it doesn't mean the economy is already in a downturn, it just means the market is adjusting to expected changes. Markets are anticipatory, economies are confirmatory. That's why maintaining a logical, objective lens matters. When you rely too heavily on emotionally driven headlines or social media narratives, it becomes easier to lose that perspective. If you want real clues from the market, you have to look beneath the surface and ask, who is leading? Is it growth or value or defensive sectors? Is leadership broad or is it narrowing? Are trade volumes rising on down days or on up days? And are futures pricing in tariff risk, earnings risk, or policy risk? Those questions help you interpret what's implied by market movements, not just what's being reported. As we move into our economics discussion, I want you to realize that not every slowdown or contraction is a recession. The word recession gets used far too casually, but economically speaking, it has a very specific meaning. A contraction simply means economic growth is slowing, while a recession is broader and more sustained, typically involving meaningful declines in employment, income, industrial production, and consumer spending. We see the definition of a recession as 2 consecutive quarters of negative GDP. That's the simple version, and one that gets recycled often. But officially, as we saw in 2022, recessions are determined by a broader evaluation of data. That distinction matters because slowing growth does not automatically equal recession. For us, we hear recession and we immediately think 2008, but that connection is emotional, caused by financial trauma, and it's not analytical. The Great Recession was not just a recession, it was a financial crisis layered on top of contraction with a housing collapse, systemic credit freeze, and bank failures. It's an event that left a psychological imprint on all of us. Since then, many people equate the word recession with systemic collapse, but history tells a more nuanced story. Recessions can vary in duration, severity, and impact. Since World War II, the average recession in the United States has lasted about 10 months. The Great Recession lasted roughly 18 months. It was long, drawn out, and painful. While the 2020 recession lasted just 2 months, it was extremely sharp but brief. Some recessions are driven by inventory cycles, some by tightening monetary policy, and some by external shocks. And not all of them create structural financial damage. Because they are not identical events, they cannot be predicted by simply connecting a couple of indicators. It's about patterns, and especially behavior, which is a piece that is often overlooked and undervalued. I want you to keep in mind there have been contractions without recessions, and recessions without crisis. Economic growth can slow meaningfully without meeting official recession criteria. That's just a contraction. And as we discussed last week, it's a normal part of the economic cycle. And some recessions resolve themselves without the banking instability or the long-term systemic damage that we saw in 2008. The truth is, the economy isn't as dramatic as we allow ourselves to believe. It moves through cycles. Some transitions are uncomfortable, some are severe, and many are simply adjustments. As I said last week, if you equate every slowdown with collapse, you will overreact. And at the same time, if you dismiss every contraction as harmless, you might underprepare. Understanding the difference between contraction and recession allows you to calibrate your expectations appropriately. Markets anticipate these shifts, and the economy eventually confirms them. Recessions, contractions, corrections, and crashes, they are going to happen multiple times in your lifetime. My clients hear me say this all the time. Building a financial plan is like owning a house in Florida. We may not know exactly when the hurricane is going to hit, but we know we have to build our home to be ready for it when it does. As we move into our strategic planning this week, we're discussing an important area where most people either overreact or disengage. A lot of times people assume everything will look better in 30 days, and if it doesn't, they start tweaking and adjusting way too early. Or they stop paying attention for 6 months and just hope it fixes itself. Neither approach works. Just like economic cycles unfold over quarters, not weeks, your financial plan should be monitored with the same rhythm. I like to use 90-day checkpoints because 90 days will always tell on you. It's long enough to reveal patterns in spending, long enough to see whether savings are consistent, and long enough to determine whether a behavioral shift is sticking or slipping. But it's not so long that small issues quietly compound into larger ones. 30 days is noise, 6 months becomes drift, 90 days reveals trends, and trends are what matters in markets and in personal finance. Now, consistent monitoring only works if you have a structure that allows you to adjust intelligently. That's where thoughtful planning becomes essential. I want you to create a structure or even an agenda that allows you to review what changes you made, assess their success, and adjust as needed. We do the same thing here at Diamond Point. We recently transitioned to a more advanced planning platform because we don't build static plans. They live and breathe with us, so they have to be adaptive. We can't expect to predict every recession or market movement, but we do have to plan through them. With the right tools, we can stress test portfolios and model how a downturn early in retirement impacts long-term income. We can evaluate tax positioning across multiple years instead of just annually. And we can analyze Social Security timing and long-term withdrawal strategies under different economic environments. We're not just asking what happens this year. We're asking, if something happens in the next 3 years, how does that ripple through the next 30? That kind of adaptability within a structure like the one you're creating now is what ultimately builds financial confidence. As we wrap up today, I hope you walk away understanding a few things. Number one, the stock market and the economy are not the same thing. Markets reflect expectations while the economy confirms them. When you understand that difference, volatility feels less personal and more informational. Number two, a contraction is not automatically a recession, and a recession is not automatically a crisis. History shows us that these cycles vary in depth, in duration, and in impact. And finally, your plan should not swing as quickly as the headlines do. It should be monitored, adjusted, and strengthened with intention, because a structure built with discipline creates stability. Next week, we're going to continue building on this foundation. In our economic discussion, we'll examine current economic indicators, discuss what deserves your attention and what likely doesn't. And in our strategic planning segment, we'll begin shifting into our March focus, which is insurance, approaching it from an educational and structural perspective. Because protection, like investing, is about preparation. Now, if you found value in today's discussion, please subscribe to the channel and make sure you're signed up for our weekly newsletter using the link below. I hope this offered some useful perspective, so until next week, take care.